Greetings and welcome to Collins Management's Basic Guide to Financial Statements. Hopefully, this will help you, the board member, to navigate the financial statement for your community. So please don't be intimidated. Let's jump in. What is an HOA financial statement? Simply put, an HOA financial statement is an official record that details all the financial activities of the community association. They form part of the HOA basis of accounting. Specific details that must be included depends on the state regulations and community bylaws, but there are some basic details that should be included regardless of size or location. There are three basic approaches to manage HOA finances. There is no right method for every association. Each HOA is different and may find that one method of accounting works better for them than another. Collins Management uses the modified accrual approach. Accrual, the most popular and preferred method. In accrual approach, revenues and expenses are recorded when they are incurred instead of when money changes hands. This means that communities using this approach will need to maintain two other ledgers for payables and receivables. For example, when invoices are sent to homeowners for dues, that money is marked down in the receivables ledger. As community members pay their dues, the money in the receivables ledger is moved to the general ledger. The same process is used for expenses in a payables ledger. While this may take more effort than other accounting methods, it provides much more detail. Modified accrual, a mixture of accrual and cash approaches. In modified accrual, revenues get recorded when they are earned, while expenses get recorded as money changes hands. HOAs that use this approach will need a separate ledger for receivables, but will document expenses as they are paid in the general ledger. Cash, transactions that are documented on one ledger as money exchanges hands. This is the simplest approach, but provides the least amount of detail. What is included in a financial statement? The balance sheet, the statement of income or the revenue expense report, receivables or AR summary, bank statements, general ledger, reserve fund report. The balance sheet. The balance sheet in your HOA financial statement is the quickest and easiest way to get a feel for the financial strength of your community association. There are three parts to a balance sheet: assets, liabilities, and equity. Assets equal liabilities plus equity. This is the basic formula that your HOA balance sheet should follow. It will provide a general snapshot of how well your association is doing financially at a certain point in time, whether it be at the end of every month, quarter, or year. Liabilities, the negative. This will be anything owed by the association, such as maintenance fees, improvements, or vendor bills. Anything that costs money will be a liability. Depreciation on community structures, vehicles, or equipment also counts as a liability and should also be added to the HOA balance sheet. Equity is what's left. Equity is the difference between the value of the assets and the value of the liabilities. To find the equity, the formula can be rearranged as equity equals assets minus liabilities. If you follow the formula and your equity is positive, good job. Your association is doing well and is bringing in more money than it owes. If equity is negative, it means that you should quickly reevaluate your finances. More money is being spent than is coming in. Not all equity is created equal. Having an equity of $5,000 would be great for a small HOA that only brings in $8,000 monthly, but not so great if your community collected $100,000 monthly. That's where the equity ratio comes in. Equity ratio can be calculated by taking your total equity and dividing it by total assets. Equity ratio equals equity slash assets. Using the same example from above, the smaller HOA would have an equity ratio of 63%, while the larger HOA's ratio would only be 5%. When listed as a ratio, it becomes quite clear which HOA is more financially sound despite having the same total equity. HOA balance sheets, whether prepared monthly, quarterly, or annually are a good representation of the daily operation of your community association. Negative equity on an annual sheet does not only mean that an HOA has lost money over the year, but it also means that day-to-day operations are flawed and need to be reconsidered. The income statement or revenue and expense statement. Unlike a balance sheet, which shows a quick snapshot of HOA finances at a certain point, the income statement shows financial information over a period of time. Usually the period of time is the rate at which you prepare your financial documents, whether it be monthly, quarterly, or annually. The income statement is considered the most important document within the financial statement because it shows the financial direction, whether that be positive or negative, of the community association. Here is an example of a revenue and expense statement. Accounts receivable or AR summary. A statement of receivables or accounts receivable statement is a document that details the outstanding charges owed to the community association. This can be from sources such as overdue dues, vendor credits, late fees, or any other outstanding source of income. It is essentially a list of every account that still owes the HOA money. These statements should contain all accounts that owe money along with the grand total of overdue funds. The total will help with budgeting purposes. Knowing how much money is available if collections are being handled properly can help with financial planning. The list of all overdue accounts can act as a checklist for anyone working in collections to ensure that no account is missed. What is in a general ledger? The foundation of all HOA accounting is the general ledger. Much like your checkbook at home, the HOA General Ledger keeps an ongoing record of all transactions made by the community association. All other financial statements, such as the balance sheet, income statement, and statement of receivables, are created based on the ledger. Unlike all the other financial statements, which are prepared on a monthly, quarterly, or annual basis, the general ledger should be continuously updated. At any point in time, you should be able to look at the ledger and see how much money the association currently has in all accounts and where money has moved. If you need to go back and see how much the association spent on landscaping in August 3 years ago, you should be able to find it in the general ledger records. What is a reserve fund? Reserve fund meaning. A reserve fund is a special account designated for long-term repairs and replacement of commonly owned property in a community association. Reserves are similar to a savings account in that will only be used for its specific purpose. For instance, reserve funds can be used to maintain the roof of a condominium building. Since all unit owners share ownership of the roof, everyone has to contribute to maintain, repair, or replace the roof. Every 20 years or so, roof shingles and other components will need to be replaced. Since this is a major expense, the condo association will set aside a specific amount of money each year to go towards repairing or replacing the roof. There are 3 basic plans for reserve funding: baseline, threshold, and full funding. These determine how prepared the HOA will be when the asset's lifespan is up. Baseline funding. Baseline funding aims to keep the reserve fund above a zero balance at the end of the item's lifespan. Fully funded reserves. A full funding offers the least amount of risk for homeowners. With this reserve funding option, the replacement of an item in question will be fully funded by the end of its lifespan. Threshold funding. With threshold funding, the association plans to have a certain limit, say 50% of the item paid for by the end of its lifespan. The upside to this option is cheaper dues. Meanwhile, the downside is that it puts the owners at greater risk. Owners may reach the end of the item's lifespan without having the proper funds available to repair or replace it. A word about bank statements. A proper bank statement should include a timeline of all deposits and withdrawals into and out of association accounts. Each account should have its own statement. It is important to carefully review every transaction to prevent potential fraud. One of the most common ways fraud is committed is by borrowing money from a long-term reserve fund and returning the money after a time, essentially taking out a loan using association funds. This is common because of how hard it is to track. If all funds are accounted for in the long run, nobody would know unless they inspect each individual transaction. Each month, our accounting department reviews each bank statement and reconciles it with the general ledger. Thank you for joining us today. Please contact your community manager if you have questions regarding your financial statements. Take care now.